Have you thought about refinancing your mortgage lately? When homeowners think about refinancing, they don't always distinguish between several options. Today, we're going to go over a traditional refinance, known as a rate-and-term refinance, or non-cash-out refinance, which simply means refinancing a mortgage into a new loan with a new interest rate. You'll also have different loan terms, such as the length of the loan and whether the rate is fixed or adjustable. So let's dive in. Hey, welcome back to the channel. I'm here to help you with your mortgage and real estate questions. Make sure you subscribe so you don't miss any future updates. And if you like this video, give us a thumbs up. First, let's cover what a rate-tandem refinance is and how it works. Then we'll talk about some of the benefits and drawbacks to help you decide if a rate-tandem refinance is right for you. A rate-tandem refinance refers to a mortgage refinance based on the outstanding balance of your loan. It's probably what you think of as a standard refinance. Your new mortgage will likely have a different mortgage rate, and you will start with a new loan term, such as a 15-year or 30-year mortgage. In addition, you may choose to refinance into a new type of loan, such as from an FHA loan to a conventional loan, or from an adjustable rate mortgage or ARM to a fixed-rate mortgage. So what is the difference between a rate-and-term refinance and a cash-out refinance? While both rate-and-term and cash-out refinancing involve replacing your existing mortgage with a new home loan, there are differences between the two processes. The main distinction between a rate-and-term refinance and a cash-out refinance is that you are not tapping into your home equity with a rate-and-term refinance. Instead, you're refinancing into a loan that might have a lower balance. Since you will have paid off some of the mortgage principal on your previous home loan, your new balance depends on how long you have been making payments on your mortgage. A cash-out refinancing gives you access to your home equity in the form of a larger mortgage, typically up to a maximum of 80% of your home value. Generally, a cash-out refinance will have a slightly higher mortgage rate than a rate-and-term refinance, since lenders take on extra risk when you borrow more money. Generally, rate-and-term refinancing is more popular when interest rates decline, since borrowers want to take advantage of reduced mortgage rates and potentially lower their monthly mortgage payments. The Consumer Financial Protection Bureau found that cash-out refinancing was more popular than rate-and-term refinancing when rates were rising. In addition to these two common types of mortgage refinancing, some borrowers with FHA, VA, and USDA loans are eligible for streamlined refinancing that requires less paperwork. Occasionally, borrowers opt for cash-in refinancing, which means they pay money at closing to lower their loan balance for the new loan. Let's look at some of the benefits of a rate-and-term refinance. The main benefit of a rate-and-term refinance is the ability to take advantage of lower mortgage rates to reduce the interest you pay on your home loan. However, you can accomplish other goals with a rate-and-term refinance, even if mortgage refinance rates are not lower than when you first took out your current loan. Here are some goals you could accomplish with a rate-and-term refinance. Lower monthly payments toward your principal and interest. Your monthly payments will be smaller if you qualify for a lower interest rate. Even if mortgage rates are not significantly lower, you may be able to reduce your monthly payment if you have substantially paid down your loan balance and choose another 30-year mortgage term. Build equity faster. Shortening your mortgage loan term from 30 years to 20, 15, or 10 years can accelerate your loan payoff date and build equity more quickly. Eliminate mortgage insurance. If your home has increased in value or you have paid down the balance, so you have at least 20% equity, you can lower your monthly payment by refinancing into a conventional loan and removing private mortgage insurance or PMI payments. Remember that you don't necessarily need to refinance to get rid of PMI. Your lender should have a process to cancel it when you have enough equity. Reduce the overall interest you pay. If you lower your mortgage rate or shorten your loan term, you can spend significantly less on mortgage interest over the life of your loan, depending on the balance and the difference in rate. Switch your mortgage loan type. An FHA loan generally requires you to pay FHA mortgage insurance for the entire loan term. So you may want to consider refinancing into a conventional mortgage to remove FHA insurance premiums. If you have an ARM and are worried about mortgage rates rising, you could choose a fixed-rate loan for payment certainty. However, mortgage rates are expected to decrease for the next year or two. Understanding the break-even point in a rate 10-term refinance. Using a mortgage calculator can help you estimate the monthly payments on a rate 10-term refinance. But you'll also need to find out from a lender how much your refinance will cost. Generally, closing costs for a rate term refinance are 2% to 5% of your loan amount, and you may have the option to roll those costs into the new mortgage. You can shop around and talk to various mortgage refinance lenders to compare loan costs. If your rate 10-term refinance saves you money on your monthly payment, determine how long it will take to make up for the money you spent on your closing costs. For example, if your closing costs are $8,000 on a $400,000 mortgage loan, and you are saving $250 monthly on your mortgage,